Today is Monday, June 3rd, and this is the ADM Investor Services Weekly Market Kickoff. Please note, the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADM Investor Services, and Alan Bush, ADMIS Senior Financial Economist. Steve, we got a bit of a grain market currently. Corn futures are testing contract highs on wet U.S. spring weather. Can this rally continue?
Some people think it can. I mean, the funds have now gone from a record short position to a small long position, and some people think that they could add if over the next couple of weeks data comes out suggesting that the crop is going to be smaller than what the USDA said, and the carryouts could be smaller, and they could add to those positions. For the month, corn prices is up about 50 cents a bushel. As we mentioned, you're up against contract highs. Some people think that we could extend that for another couple weeks until we get maybe 85% of the corn crop planted. Once that's done, the market might take a pause.
What's the weather in the next 2 weeks, Steve? Are we going to get this corn in?
Some will. I mean, we're expecting that tonight about 70% of the corn crop will be planted. And when you look at the 2-week forecast, there's heavy rains across parts of Kansas, Oklahoma, Missouri, southern Illinois, southern Indiana, the Delta. Those are the areas that have been getting a lot of the rain to date. But north of that should be dry. And so we should get crops planted north of that area. So the key probably area that the market will be watching for is central Illinois. They still haven't got a lot of planted there, but at this forecast, they could actually get some stuff planted.
Is there a cutoff date? I mean, how late is it to plant corn?
There's a crop insurance policy that somewhere around the Midwest, central Midwest, June 5th and June 6th, farmers could start asking for prevent plant, which they would get a certain amount of money not to plant. Most farmers, though, I think would still want to plant the corn, especially with the rally that we've seen in prices. If their yields are below their proven yield, and if they don't quite have the production, they could actually net out more than if they tried to plant the corn than if they take the prevent plant option. So the farmer still wants to plant corn.
Turning to beans, Steve, the July soybeans have left gaps on the weather rally and fund short covering. Do the fundamentals support this rally? And do the chart gaps at lower levels have to be filled eventually?
Some people feel the gaps have to be filled, but not immediately. I think that the market is up today, short covering following the higher corn and wheat prices. United States and Mexico is supposed to meet on Wednesday to see if they can hammer out some type of an agreement before the president puts tariffs on Mexico goods. Some of the things, Mexico's the #1 buyer of U.S. corn. They buy 140 million bushels of beans and 1.5 million tons of meal. So if they come to an agreement, that's demand that we won't lose, and it might help the marketplace. But when you look at a billion bushel carryout in beans, they don't justify $9 futures.
Steve, July wheat futures have rallied since contract lows were made in May. Prices have retraced the entire down move from February. Why have the wheat futures rallied?
I think it's 3 reasons. I think, first of all, these rains are beginning to raise question about the quality of the U.S. winter wheat crop. We may not lose bushels, but we could lose quality. We've also noted as the Russian crop gets into the final stages of its growth period, it's hot and dry there, and so we might lose some bushels there. And as goes Russian prices, so U.S. futures go. And then I think the funds just have an appetite all of a sudden to get out of short positions. They got out of their short corn, they're getting out of their short beans, and the final thing that they probably have the biggest net short compared to open interest is Kansas City wheat, and they're starting to get out of those positions.
Finally, Steve, what are the latest estimates on the 2019-20 corn, bean, and wheat end stocks versus the last USDA report?
Everyone's still holding on close to 1 billion bushels of the soybean carryout, which is negative. They're looking at a wheat carryout also around 1 billion, maybe 1.1 billion bushels, which is negative. The big one is corn. The USDA said that we might have a 2.4 billion bushel carryout. Some people think that carryout could be as low as 1.4. That is one thing that could surprise the market either in the June S&D or the July S&D report.
Alan, what are the main fundamentals affecting stock index futures currently?
Well, the 2 dominant fundamentals, of course, is the trade situation between the U.S. and China, and then, of course, now with the situation between the U.S. and Mexico, that being a big negative. But a very big positive is the interest rate situation, which is becoming very bullish, with all of the major central banks around the world being pressured to lower interest rates. So we have these two diametrically opposed fundamentals that tell me to stand aside in the stock index futures for now. There are other markets to be trading that have the fundamentals more aligned the same way, and that would be the flight to quality vehicles.
So U.S. Federal Reserve officials are saying that monetary policies will likely remain on hold for the rest of this year. Is that likely to change?
I think it is very likely to change. In fact, financial futures markets now are predicting that there will be a rate cut either at the July or the September meeting, and another one in December. So I think the rhetoric from the Fed is likely to become a bit more dovish, maybe a lot more dovish in the days ahead.
What is the best flight to quality vehicle to buy in light of the ongoing U.S.-China and now U.S.-Mexico trade uncertainties?
Well, that has been and remains the 30-year Treasury bond futures. And in fact, all of the interest rate futures markets have performed extremely well and better than some of the other flight to quality vehicles, such as the Swiss franc and the yen and the gold. But all of those have performed very well also. But it still goes back to the interest rate markets, especially the bonds. That's where to be on the long side.
Do you have a specific trade recommendation in the 30-year Treasury bond futures?
Buy every break in the 30-year bonds. There is a lot left to the upside, especially with all of the central banks, the major central banks around the world, likely to lower rates to one degree or another. Be long the 30-year bonds. Any break should be used as a buying opportunity.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.